it possible you could please share 2 investment themes or ideas that you think will be really important to investors' portfolio returns over the next 5 years?
The whole ESG space, and again, that's not terribly unique. It's been around for a number of years, but in our experience, in the last 6 or 12 months, that momentum has shifted enormously to the extent that there is much more focus both by investors, advisors and fund managers and what they're doing from ESG assessment and practices perspective. So we've already seen, I think, examples both ends. So examples of companies that are following, let's say, good environmental practices and being bid up. And so they've really performed very well from a share price perspective because they're seen as sort of ESG type leaders. To the opposite extreme of where, I guess corporates have done things that haven't been socially acceptable and so have been really punished by the market. So, I do think that plays out pretty strongly from here on in, and certainly in the time frame you're talking about, the next 5 years. So that's a big one, I think, that has big implications for how money's both managed and invested.
But one of the themes is ESG. Certainly, sort of the shift to focusing on ESG as part of your investment is coming off a low base, but it is growing, and we're seeing more and more managers responding to what's, that sort of bottom-up demand and thinking about what it means for their processes and the product sets that they have out in the marketplace. And the other piece of the puzzle, I guess, is very much on this, the sort of value v growth piece. We're seeing value come back hard, and I think that's an area where we're starting to sort of watch what that means for portfolio construction, so to speak.
I still think some of these structural disruptive drivers, if you wish, are going to be driving longer term returns. I mean, I look at digitalisation and automation as being, if you wish, that 4th industrial revolution, I think it's been called.
Yeah.
I see that as a structural change. And you look at bottom up what companies are doing, and they're investing in automation, in digitalisation. So I don't see that going away. I genuinely believe that is a structural driver. The other one, I think, once again, it's that the rise of the middle class in Asia and in the emerging markets, but especially in Asia, I once again see that as a big long-term structural driver of returns, and it just means that the sort of industrial type sort of companies in those markets do better than the local, like a developed market where we don't have that sort of driver. So those are the 2 things I still think are genuine long-term structural drivers and will be of portfolio returns.
Are you able to give me some examples of funds that have been through the Lonsec process that provide access to those longer-term thematics you've just discussed?
Yeah, sure. I mean, in terms of the automation, the digitalisation, it tends to be the domain of the sort of growth manager, and especially the high growth top managers. Now they've had a big correction of late, and that's a short term. And look, they came from a period of pretty high valuation, so it was natural then that valuation, as we get some different sort of narratives in the market, starts to come off. But I think that sort of high growth manager, and I'll give you some examples such as like a Hyperion or a Benelong in an Australian equity context, or in a global equity context like a Bailey Gifford. Also Hyperion's got a global equity strategy there now. And those sort of managers can really sort of tap into that sort of, that company that can really drive that sort of disruptive, innovative curve. Yeah. From a sort of Asia exposure, although we've got a lot of Asian type strategies. We've got passive options. We've got Asia, which is like a tech all-stars, an Asian tech all-stars. Or you just get some of these sort of Asian strategies out there, like a GQG and those sort of strategies, who actually take an active approach and pick stocks and the like.
We recently started to rate fund managers along what we call a ESG commitment level. And what we're finding is that compared to global counterparts, particularly European counterparts, the fund management industry in Australia is in the early stages of sort of deep adaptation of ESG.
It sounds like that's a very generous way of saying we're behind.
We are, yes, that would be, and certainly managers that we've rated so far, which is only a very small cohort of our overall coverage. Some of the intentional strategies, people like Australian Ethical, we recently gave the highest ranking to one of our investment AIM, which is a fixed income manager in sort of the green bond space. They're two managers that have taken out our highest commitment level, which is sort of leader. But what it demonstrates is that if they've been doing it for a while, they have a very established process, they have a higher chance of getting better ranked in our commitment level.
Well, I think here in the Australian market, let's face it, Pendal's been probably at the forefront of that, having a dedicated ESG business that they acquired within the group. Managers, I guess, like Impacts, which is now coming into the sort of Fidante suite. You've got PIMCO, obviously the largest global bond manager in the world, having a global ESG bond fund. It's been quite a specialist field, so you've seen some of the smaller managers sort of evolve and be really successful in acquiring, funds and interest from investors.